Hello everyone, my name is John Locke from thewinningtrade.com and I would like to welcome you to The Winning Trade. But first, the required disclaimer material. This presentation is given for educational purposes only. We're not broker dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, and please make sure you are aware of all your risks prior to placing any trades. Also note that in this presentation, we are using hypothetical computer simulated trades. They're believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many, many different reasons. All right, so let's get going. For those of you who have not seen us before, my name is John Locke from Locke in Your Success LLC. I'm a trading performance coach and mentor, and myself and my team are here to help you win in the market and in life as well. And today I'd like to take you into the realm of high probability options trading. Now, high probability trading is quite a bit different from the trading that you might be used to. In normal trading, a lot of times you'll find a stock or an asset, or you'll buy an index and you'll hope that that index goes up. And sometimes it does, sometimes it doesn't, sometimes it goes down. But in order to make any money at a given period of time, that asset has to go up. That's different with high probability options trading. In high probability options trading, we are taking advantage of the passage of time, and we're doing that through using options. And by doing so, we can often win whether the market goes up, down, or sideways. Now, this doesn't mean we're going to win all the time, but it does put the odds much heavily into our favor that we're going to win more often. The trading strategy we're looking at today is called the bull. Now, the bull is an extremely simple and easy to manage options trading strategy on the Russell 2000 index that takes advantage of bullish and neutral market conditions. The way that it works is on the Wednesday closest to 65 days to expiration for a particular option cycle, we're going to enter a 30-point wing bullish vertical on the Russell that gets a credit of more than $2.50 per contract. From there, what we're going to do is essentially nothing. We're just going to sit there, and you do want to check the position once per day to make sure that it's not in trouble. But other than that, you really just kind of sit there and let time pass by and do its thing. So as time passes by, we're going to exit under one of two conditions. Exit number one is if the position draws down to a point where the drawdown is greater than the credit received. So if we receive our $2.50 in credit and the position draws down that $2.50, then we're going to exit the trade. Exit two is going to be when a certain amount of time goes by. So when the next cycle or the next monthly cycle is ready to be entered, which is going to be approximately 30 days, when that cycle is ready to be entered, we're going to exit the position that we're in now, and we're going to enter into our new position, meaning there are no overlapping trades in this particular strategy. Now, the bull requires a minimum of $2,750 if we're trading it on the Russell 2000, and a minimum of $275 capital if we're trading it on IWM. So you can trade this position with a very small amount of capital. It does not, as far as a profit target, it doesn't really have one. If you get your maximum credit, then you can exit the trade early if you want to, but the rules basically say we just stay in until the next trade cycle is ready. The exit loss trigger, or when we're going to exit the trade, as we talked about, is when we're down the $200 or $2.50 per contract. And when we do our example size that we're going to be showing you today, we're going to be doing it with what we call 10 contracts. In other words, if I were to do one contract on the Russell 2000, our planned capital or the amount of money that we have expected to have in the trade is $2,750 or less. If we go to 10 contracts, we multiply that times 10, meaning our contract size is going to be, or our minimum capital on the size we're doing is going to be $27,500, and our exit loss trigger on that amount of capital is going to be $2,500 on those 10 contracts. So let's take a look at the position and we'll show you how it works. We're actually going to go through 3 consecutive cycles because the trade is so simple. We want to make sure we show you what's going on. So let's take a look at our January expiration cycle for 2021. So what we have here is the date is November 11th, 2020. At this point, our January options, which are right here, our monthly cycle expiration is 65 days to expiration. And that being the case, we're going to come in here and we're going to sell a put vertical spread. And we're going to do so that we have a credit of at least $2,500. So if you look up here, this credit line is going to be $2,500 or higher. In this case, it's going to be, our current income here is $2,680. So for those of you who have not seen this software before, this is something called an analytical software. It's not necessary for this trading strategy because realistically you can put it on. Within your broker, you know how much credit you get, and you can just watch your profit and loss in the position. And if you hit your exit loss trigger, you exit. Otherwise, you go a certain amount of time and you exit. So this software isn't required for this, but you should understand the software if you're going to be trading option strategies such as verticals and stuff like that. So here we have a software called Optionnet Explorer, and each of these columns is an options expiration cycle. As we showed you or talked about before, we're looking at the January 2021 cycle that expires on January 15th, and it's 65 days to expiration. These are our calls. Underneath are our puts. This here, we usually start at around 10 delta, and then if that doesn't give us the credit we want, then we'll keep increasing or going higher until we get the credit we want. In this specific case, to get the minimum of $2,500 credit after execution, we had to go to our 11.79 delta. Again, the delta number isn't important. It's just a good place to start when you're wondering where to put the spread on. So here we did the 1460s. We sold the 1460s. We bought the 1430s. If we do that, it creates a certain risk profile. This is what we see over here. So over here, we have the asset price of the Russell 2000 along the bottom. We have our profit and loss in dollars up the right, and our profit and loss in percent up the left. So here you can see that we have a credit of about $2,500. We have a maximum risk of about $27,500. They're a little bit different than that, but that's about approximately what we're looking for when we're setting this up. And in this case here, the blue line here, or the deep or dark blue line, is called our expiration graph. And what this is this shows us the actual value of this position, what it's going to be in 65 days when our January options expire. So on January 15th, 2021, this position will be worth whatever that blue line tells us on that date for any given price level of the Russell 2000. We're not going to let this go that far. Again, we're going to exit this when the next cycle is 65 days to expiration, which is going to be our February. And this other line that goes from red to blue and eventually to green, but you can't really see it here, that line is called our T+0 line, and that is the estimated value of the position at any given price point on the Russell 2000 as of today. Over time, this T+0 line forms or shapes itself to our expiration line until we hit expiration, and then of course it is the expiration line. So as far as adjustments on this position, there are no adjustments. And that's one of the things that makes this position challenging to trade for some people. It's also very educational, and it works on your ability to follow rules while letting things that are out of your control, letting them happen. And I find this very, very good for traders in their development, which is why we recommend this trading strategy for all our traders in our Trading Success Blueprint as a starting point. Number one, because it's extremely simple, and number two, because it teaches you or conditions you to follow the rules and let the market do what it's going to do and let it happen. And in the meantime, while you're doing this, this is also a fantastic strategy that historically, over long periods of time, has excellent, excellent returns. So we have no adjustments to this. What's going to happen is if this position draws down $2,500, then we're going to exit it. Otherwise, we're going to sit in the position until our February expirations, which aren't yet listed, hit 65 days to expiration, and then we're going to exit. at whatever profit or loss we happen to have. And that's essentially all you do here. Now, there are some nuances to rules, and we have some filters available to it, and some other things that will maybe keep you out of the market at certain times when the strategy is not particularly likely to do as well as other times. And those are available to our Go members in our FIT program that is available with our Go membership, okay? So this is the basic strategy, and we're going to do nothing. So let's just take a look at how this progresses here over time. You can see we get a down move here. The position draws down a little bit. That's natural, and as long as we don't get down to about 1625 area, really that's not really a problem for us other than a temporary drawdown. So that's because over time, and this distance is going to increase over time as well, right? So if we're in the strategy for say 2 or 3 weeks, this T+0 line actually rises a little bit here. So you actually have more room as time goes by. So let's just go to the 13th. You see we bounce right back up. We're profitable again. And now the market's taking off. And I'm just showing you how this develops over time. So now we're up, what, about 1,430. So as you can see, the up and down price movement at this point really isn't bothering us. Also, another thing you should notice as time goes by, we're getting more and more room to the downside should the market come down, meaning that a lot of times the market can be below where you entered the position and you can still make money, which is really cool. So let's just push this forward. You can see we're 42 days to expiration now, and we're up about $2,130. And from here, there's really no problem. I'm just going to push ahead until our exit date. So we're just going to sit in this position. And again, the only time you need to even look at the position is if the asset price is substantially below the asset price where the position was entered. So realistically, if the market goes up and you set an alert to the downside, then you make sure you pay attention to that alert when you get it. There's really nothing to do here. So let's just go to, I believe the 16th is probably exit day. So let's take a look at what we look like. So here we are, and it's December 16th, 2020. February is now 65 days to expiration. That is our exit trigger for this trade. So as of right now, the trade is up about $2,430, and that's going to be approximately 8.8%. Really fantastic return for a single month. And this being the case, we are going to just exit this, and we're going to re-enter February the same way we entered January. So we'll close this position out here at our profit. We will enter our February position. Here you can see we have a credit at this point of about $2,630. Puts our current total risk at $27,370, which is the amount that we have total in the position. Again, we would never let it draw down that far. We want to get out if we perhaps, if we happen to hit a $2,500 drawdown, which in this case would be if the Russell gets down probably to about 1850, we'd be looking at an exit. So unless we get down that far, there's really no reason, again, to even look at the position because there's nothing to do. So let's move forward a couple of days, and we'll show you how this works out. Once again, you can see the markets moving back and forth, but over time, this T+0 line here is actually rising. And if we actually get the added benefit of up movement as well, that only makes it better for us, which we've had pretty much for a while now. So you can see we did have a pullback in the price chart. right? So we went up a little bit, we pulled back quite a bit, but you can see we're still at break even. So one of the things that a lot of traders don't think about that do market neutral strategies is the pullback in the market after the price has gone up a bit. So you see a lot of broken wing butterfly strategies out there, which is really cool. I mean, we have a lot of them ourselves. They are generally entered more neutral delta and then adjusted if the market goes up. Now, the challenge you can have with that is when the market goes up and you adjust it up, you're taking on additional downside risk, and you haven't made any money. So that being the case, if you get a down move, so in other words, if you get a substantial up move and you have to make a lot of up adjustments, and then you get a substantial down move in the market, that broken wing butterfly a lot of times is going to have a problem. Sometimes it will hit its exit loss trigger, and you're going to end up losing. Where here with a bull strategy, one of the great things about this, if you get a really big up move and then the market comes back to where it was or maybe a little bit below, it's not a problem, right? You don't get that drawdown. So there is a benefit to being positioned this way over something that's a little bit more neutral. So keep that in mind. Anyway, this is what we look like on Jan 4th. And it looks like our pullback is over. And we withstood that really well. And I don't think there was another problem after this. And as I was saying, right, if I was in a broken wing butterfly and I got this really big up move and I wasn't up any money and or maybe I was down money and I had to adjust to get profitable, that puts me vulnerable to a move back to say 1950. This here, not a problem, not a problem. So that's, again, one of the things I love about the bull strategy. And let's just, actually we're 70 days to expiration for March, so let's just pop this another 5 days, which is the following Wednesday. And this is what we look like. So now our March is 65 days to expiration. We're up less money this time, but still a very, very good profit. Let's see, it's about 6.6% return in approximately 30 days. And it's time to exit because our March is 65 days to expiration. So we're going to close this position out. We're going to reopen in the same manner we did in January and February. So if we take a look at this here, this one here was what, 11.19 delta. We have a credit here of a little over 2,500, and about 27,470 in margin. And again, this is what the position looks like. And then as we move along here, let's see if we can get one in a little bit of trouble. I think we had a decent downsize move in this cycle here. There we go, right? So here, this was the last down move we had during the trade. This one is a little bit more severe. It happened a little bit earlier, so we have a bit of a drawdown here, $820. We back to neutral the next day. And now that we withstood our pullback, I think we're good to go. And this here is February 10th, 2021. Our April position is 65 days to expiration. This is just this last Wednesday. The position is up $1,730 for about 6.2%. Not bad for our third month in a row of profits here. And it's time to close this position. And what we're going to do is we're just going to close that out, take our money, and again, we're going to do the same thing, reopen in our April expiration cycle, and do the same thing over again. So that is the bull trade, and that's three monthly examples in a row where we're doing well. This does extremely well in a bullish market, obviously, particularly ones that are not overly volatile. We can have some trouble in bullish markets that are overly volatile. In other words, if the market comes down too far, we were having that trouble a little bit in 2020. We hit some bad timing marks, but here in 2021, this strategy is expected to do extremely well. We're clearly in a bullish market, and the volatility or back and forth movement in the market has settled down a lot, and enough where I would expect this to do really, really well. And that was a triple win for our bull strategy. This episode's winning trade. Also remember that the bull strategy is available for you to learn within our Go membership in our FIT program, as well as other great strategies such as the Super Bowl and the quick and dirty broken wing butterfly. Also, I invite you to visit us at lockingyoursuccess.com and discover how you too can follow along with this and many other great strategies as they unfold during our weekly trade update webinars. Also, where you can learn about upcoming winning trade presentations and explore past winning trades and receive full access to free bonus material that will help you become a much, much better trader. And of course, while you're there, make sure you check out our free Trading Performance podcast, where you can learn to skyrocket your trading results regardless of the type of trading you do. If you have any questions or comments or anything you'd like to see on the next winning trade, please make sure you comment on the video below or contact us. And if you leave a question or a comment, I'll make sure I answer those questions for you personally. Thank you, and I look forward to seeing you on the next winning trade.